Welcome to the Pearl Planning Summer Economic Update and Investment Outlook. I am Melissa Joy, and I am so pleased to be joined by the rest of the Pearl Planning team who's sharing today. Let me do a couple introductions. First, we've got Jay Fredenberg, who is the newest member of our team, and I want to give Jay a warm welcome. Hi, Jay.
Hi, Melissa. Thank you very much. And thank you, everyone, for joining us. Really look forward to this presentation. Great to be here.
Jay is I've known him for years, and he joined us after retiring, an early retirement from Goldman Sachs, where he was vice president. We're also joined by Hannah Near from Pearl Planning Charlevoix, as well as Melissa Fradenburg from Pearl Planning Grosse Pointe. She and Jay serve the Metro Detroit area and also work with clients out of our Birmingham office. So without further ado, let me share the screen again and we'll talk about where we're going today. I like to say for today, we're going to do a story of telling the good, bad, and especially ugly of what has been going on in the stock market and also in bond markets and just investments in general. So we're going to kind of tear you down and then we're going to build you back up, because then we're going to turn around and talk about forward-looking outlook, and also most importantly, at the end, we will give you the actionable things that you should be considering doing as a result of the conversation that we're having, because we're giving you information, but we want to make sure that you're walking away with some really proactive action items. And so that will be at the conclusion of our conversation. And so we hope you'll learn a lot, but also feel like you know what to do with that information. So let's kick it off. I'm going to talk about current markets, and of course we will make sure to discuss inflation, which is on everyone's minds, as well as the potential question mark for recession, and then just the rest of the US economy if that were not already enough, and then stock markets and bond markets, which have each told their very unique and interesting and let's call it historic stories, and then how do we invest from here. Okay, speaking of historic stories, I know that when you listen to people like us, we always like to talk about how we live in unprecedented times. It's something that grabs your attention, and it's something that, you know, really becomes noteworthy and is kind of a shiny object. Well, in this case, we are looking at start to the year for the first 6 months that really was extremely unusual. You start off that this was the worst start to the year, not worst year, but worst start to the year for the S&P 500, which we always use as a benchmark to measure kind of success or results of US stocks. And we would have to go back more than 50 years to 1970 to have a worse start to the year. So, you know, may you live in unprecedented times. That's strike one. Now you look at the bond market, and bonds are measured by interest rates and the yield that they pay you. And that yield plus the price of the bonds results in returns for bonds. And typically bonds are considered a safer way to invest than stocks, less risky. And you can see in the gray lines in the chart in the middle, that's a bunch of years of the start of the bond market. And typically it stays pretty close to zero or it goes up. And in a few cases it goes down. So it's not unreasonable for bonds to have gone down, especially when interest rates are rising. But then you look at this year and it's really bad. The worst year on record. So bonds have in general are down more than 10% year to date through June 30th. And so that again is a big piece of news, because the bond market is what kind of mitigates the returns of the stock market. So we're dealing with that this year as well. And so of course, when you add the chart on the left to the chart in the middle, you get the chart on the right, which says that it doesn't help you. You don't really have a lot of places to hide when you invest in a diversified portfolio so far this year. In fact, in the first 6 months of the year, investing in a diversified portfolio, you see that one of these things is not like the others, is a big outlier in terms of how difficult the market has been for investment returns, much worse than 15%, nearing 20% down year to date for a 60-40 stock and bond portfolio. So I told you I would tear you up first before we build you back up. And so let's talk a little bit more about the stock market first. We had an extremely short bear market in 2020, in March of 2020. And then we now know that we're in a bear market, which is measured by a decline from the price or return of stocks of more than 20%. And so this bull market that we just had, which was extremely strong, was also very short, only 22 months long, the shortest bull market on record. So again, there's another kind of stat that we pulled out to tell you how specifically different this time is. And then how has this bear market been presenting itself? Well, on the right, what we're showing you is a magnitude of pullback of different stocks of the Russell 3000. So that's 3,000 stocks of different sizes from big to small. From an index called Russell, and it's measuring how far off all-time highs the stocks are. You'll notice less than 1%, in fact, 0.2% of all stocks are at their high. So that is a very unusual and fractional tiny number, a number that would have been quite large just in 2021. Then you look at stocks that have lost less than 10%, and that really is only 4% of a very broad piece of our US stock market. And so about 12% are down between 10 and 20%. And then those numbers get even worse with 32% of stocks down 50%. And when we talk about investing lessons, I'll have you compare that 30% of stocks down more than half versus the returns of the index, which are bad, but only down around 20%. And these are some of the lessons for some of you when you look to buy individual stocks and say, no, I want to really be a good investor and buy individual stocks. Well, these are some of the lessons that you learn when investing in individual stocks, is that on the other side of things, it can be really, really punishing to be on the wrong side of those stock picks. And accompanying the negative returns is often investor sentiment, or perhaps we could call it emotion. And when we track sentiment, these again are quite special, unique times. You'd have to go back more than 40 years to 1980, also a time that was accompanied by really challenging geopolitical events as well as inflation, to see a time period that had such negative investor sentiment. And you can see the lines in terms of where sentiment has been over time in this chart. From our blue dot, looking back over time, the returns over subsequent periods, when sentiment is so low, tend to be high. So that's what this chart is telling us, is that looking forward after a trough in sentiment, and we don't know, we could go lower, but we're pretty darn low. When you look forward over future months, and this is starting to build you back up, returns coming from those points in time where you get to the low or the nadir of sentiment tend to be quite strong for stock investments. We're going to get a little more into the specifics of the economies and stocks, though, and I want to hand the proverbial baton off to Melissa Fradenburg. Melissa, welcome to the podcast. You've done a lot of work to pull this together. Tell us a little bit more about what's going on and why we're experiencing this difficult market.
Absolutely. Well, similar to Melissa, I am probably going to take us down a little bit and then back up, hopefully. But let's look at kind of how we got to where we are with these markets year to date. So first of all, just coming out of COVID and the lockdowns, we came out hot out the gate, obviously year over year, from our economy being shut down and all that pent up demand. We came out hot, and that caused some inflation. Now, on top of that, we also had two what we would call kind of black swan events on top of COVID. One, which was China's zero COVID policy, which essentially shut down major cities and ports with just a few cases of COVID. And that continued to put pressure on the global economy, as well as additional strain on already strained supply chains with those large ports being shut down. We are seeing some hope there that has subsided. However, the other black swan event that we saw this year is the Russia-Ukraine conflict, which continues to weigh on everyone. And We are not sure how long and what the outcome of this conflict is going to be. So on the next slide, I'm going to show you kind of the domino effect that this Russia-Ukraine crisis has had, again, on the markets that we've seen so far this year. So that conflict has caused oil prices to be quite high. And you notice in the first chart here that crude oil and headline CPI both at extremely high levels. And in fact, inflation is at a 40-year high. So that has led to the domino effect of the Fed rate expectations also going higher. So in the beginning of the year, we had a Fed forecast for the year end of 75 basis points. That is now at a forecast of 3.4%. So that is a huge increase in the Fed forecast, which then has the domino effect of increasing the probability of a recession. So if we look back in the first quarter of 2021, there's less than a 2% chance of a recession. And now we're looking at a 68% chance of a recession in the next 2 years. So the thing is that just because the market is predicting it doesn't mean that it actually will happen. And if we look at the economy, these slides here are kind of some of the reasons why we don't feel, at least for this year, for 2022, that we will see a recession. The first one is the job market. So if you look at the historically high withholding rate here, that is a sign that people are earning more. Employment numbers came out and there are over 11 million jobs available. So if you want to be employed, you can likely find a job. In addition to that, consumers have elevated cash positions. So there's over $2 trillion in savings right now that the consumer has to spend, which will really help with some of the inflated prices that we're seeing right now. And people are spending. TSA screenings are at a post-COVID high of 2.5 million. If you're like me and you've gone to a restaurant, you will notice that restaurants are quite crowded. You need to have reservations for a date night, or you end up eating at the bar, right? They're actually up 7% from pre-COVID levels, so back in 2019. Hotel occupancy is at a post-COVID high, up 71%. And weddings, I mean, myself, I've been to one already this year, and I'm old, so I'm not usually going to weddings, but 2.5 million weddings expected this year, and that would be the most since 1984. Concerts, also went to one of those, completely packed. 70 million tickets sold year to date, which is 36% above, again, the 2019 pre-COVID levels. Gas prices, we talked about oil being high. We still had, over the recent 4th of July holiday, a record 42 million drivers on the road. So people are traveling, they have cash, and they're employed. So those are 3 of the reasons why we see a recession for this year, not very likely. However, in 2023, we do see the probability of a recession rising. And Raymond James economists are saying there's a 60% chance or probability of a mild recession. So I'm going to talk a little bit about the reasons for that here in this slide. One is, as we talked about, the higher than expected inflation. Initially, it was thought that the Fed could raise rates to a more neutral position that would slow the economy but not be restrictive. Now it's looking like, because inflation has stuck around a little bit longer, a little bit higher than expected, that they may have to raise rates to what we would call a restrictive level. And at that rate, that means that interest rate sensitive areas of the economy, like housing, would likely be impacted, which could lead to a recession. Now, the second part of that is the self-fulfilling prophecy, which this graph here shows the Google search. I don't know if you're like me, I Google everything. So anything that's on my mind. But right now, one of the highest Google searches is recession. And in fact, it's higher than levels when we were actually in a recession, both in COVID in 2020 and back in the great financial crisis in 2008. So the thought here is, if people are anticipating that we will have a recession, that they will curb their spending and make less purchases, which then could actually create an issue where we have a recession, a self-fulfilling prophecy. So again, the Raymond James economists, and we believe that if we do see a recession in 2023, it will be in the second half, and it would be more of a mild recession. Now, if we look, this chart here kind of shows a history of the federal funds rate. Right now, we are at that gray box, 1.63% this year. But if you look at the blue line and those boxes, those are the year-end estimates by the FMOC for the Fed funds rate, which you can see is quite higher from even where we are now. I do want to point out, though, historically, it is still under rates that we would see back in 06 and 07 and back in 01. So if the Fed fund, the purple diamond there at 2.5% is the long-term projection of 2.5% for that Fed funds rate. It's a question of how we get there. And you see that the market expectations are slightly lower than the FOMC estimates. And really, it's a question of how we get from here to that 2.5% that will really determine whether we have a soft landing or a potential recession. And what's interesting is this slide here shows that if you're looking back at maybe your June statements, a few weeks ago, we were down 24%, the S&P from the highs, as Melissa mentioned, marking the bear market. Well, we've actually come back. We had a nice little rally yesterday, and as of yesterday's close, the S&P is down 18%. However, that 24% is actually factoring in a mild or moderate recession. So the average S&P decline in a mild and moderate recession is 24%. For a severe recession, which would be marked by a GDP loss of greater than 2.5%, the average decline in the S&P is 37%. So certainly there is a chance we could see lower lows than we have already. But again, we are calling likely scenario if we have a recession, it would be that mild to moderate. So certainly with headlines, we could retest those lows, but we do feel like at that point, if you're just looking at your June statement and feeling completely nervous, do know that that is already factoring in likely a moderate to mild recession. And now I'm going to build you back up again with some good news here. So as those previous slides kind of talked about inflation as one of the main drivers in the market that we've seen so far this year. And that number that just came out last week as we were putting together this presentation of 9.1% CPI for June was certainly greater than the market expected and historically high inflation. There's no way around that. However, it's important to point out that while the market is forward-looking, that CPI number is backward-looking, and we are almost here at the end of July, and we are seeing some signs that the inflationary pressures may be cooling. The first one is the normalizing of the money supply. So a year ago, we were still seeing fiscal stimulus, and we were seeing basically the government printing money to buy bonds. And as you can see in that first graph there, that has really come down year over year. So with less money in the money supply, that should really help to ease inflationary pressures. The other one is unprecedented inventory growth. So I know in previous economic updates, we talked a lot about low inventory and shipping supply issues. Well, now major retailers actually have 20 to 30% more inventory than they had pre-COVID. So even in the last week, you'll see major sales at Target and Amazon Prime Day. So we feel as these retailers are trying to reduce some of this inflated inventory, that should put some downward pressure on prices as well. The next slide, auto prices are starting to come down. And this index here, this is showing used vehicles. New vehicles haven't quite come down yet, but it should lead to that. Anybody that's tried to buy a vehicle over the last year probably has felt that increase in prices, so that's a really good sign. Falling freight costs. The price to ship from Shanghai to Los Angeles has basically is now at the level where it's flat with where it was a year ago. So it's come down quite a bit off that high that we saw 6 months ago, which is a really good sign. And again, if that continues in that trend, that should have a good effect on inflation. Semiconductor prices. When I talked about vehicles, one of the main reasons why new vehicles costs have been so high is because of the supply chain for the semiconductor. That is starting to show signs that it has peaked and come down a little bit off the highs. Falling fertilizer prices, another place where the consumer has really been feeling the inflation is grocery store. My grocery bill is about double what it used to be. So we see here that the cost of fertilizer has been falling, and that is a really good sign, and that should have an effect on the cost of a lot of the groceries that have been inflated over the past year. And lastly, economically sensitive commodities are falling. So here an example is copper, and we see that the trend is starting to move downward. If we continue to see that trend, that would be a very good sign that inflation has peaked or is starting to come down, and that would have a really good effect on the equity market. And to talk a little bit more about what's going on in the equity market, I am going to pass it on to Jay.
Thank you very much, Melissa. I really appreciate that. Great job. And Melissa Joy, thank you very much for that kind introduction. Really appreciate that. So over the course of the next 5 slides, as Melissa said, I'm going to talk about equity markets, stock markets, bond markets, corporate earnings, rates, and yields. So as we can see here, we're looking at annual returns for the S&P 500. And as Melissa said, we use the S&P 500 as a proxy for the stock market. The main point, or the main point that we want to make is that as long-term investors, sometimes it's very hard, especially like the year that we've had so far. It's hard to maintain, but very, very important to maintain a long-term perspective. So what we're looking at is the red dots, or the red numbers, represent the intra-year lows for the S&P 500 or the stock market, and then the gray bars represent the returns every year for the stock market. So what should jump out is that although every single year going back to 1980, the actual return, not always positive, but is better than whatever the intra-year low was. In fact, if we look at the 42 years, 32 of those years have actually been positive, or 75% of the time. So again, the key message that we want to say is that, you know, history is on the side of investors who are able to maintain a long-term perspective, regardless of short-term market movement or volatility. So what we want to look at here, or what we are looking at here, is corporate earnings, as well as a decomposition of returns or drivers of the return. And again, we're looking at the S&P as a proxy for the stock market. The key message, or the main point that I want to make, is that, you know, long-term investors, when considering stocks, should look at earnings. We're going to talk about how other things influence over the short term, but over the long term, earnings are what drive the results and performance. So looking at the chart on the left, what we see is the annual earnings growth, or lack thereof, for the S&P 500, or companies within the S&P 500. The green bars are years where earnings are negative or contracting. The gray bars are years where earnings are improving or expanding. And then the blue bars, what those represent are analyst estimates, or the consensus of analysts on Wall Street and what they think of earnings going forward. So this represents earnings growth in 2002, 2003, and then in 2004. And as you can see, the expectation is that the corporate earnings or earnings of companies within the S&P 500 are increasing pretty positively. In fact, over the course of this past year, earnings growth has been just under 7%, which leads me to let's take a look at the chart on the right. If you look at the gray bar, which is on the top there, going from left to right upward, that represents the earnings growth of 6.7%. So if we look at the blue bar, what that is the multiple. That's represented by the price earnings ratio, or the price that investors are willing to pay for the future earnings of the corporations or companies within the S&P. So as you'll see, that multiple has come down almost 30%. So when you add that to the earnings growth that has been positive, you get a price return that's negative 20.6% as of June 30th. So here's the point of all of this, where a long-term investor should use earnings as the guide, and earnings are positive, and stock prices follow that over the long term. Over the short term, that multiple can dominate the price return. So hopefully that's useful. What we're going to look at on this next chart is the valuations and then time. And the point that I want to make here is that the price that investors pay for stocks does matter, but what matters most is the time horizon that stock investors have. So we looked at that multiple that's come down almost 30% so far through June 30th. So much so that the average PE ratio, or the valuation, has brought stock prices, again using S&P 500 as a proxy, below the 20-year average. So again, the price you pay matters, but the time horizon that you have matters more. So if we look at the chart on the right side, what we're looking at, since 1950, we've had 10 bear markets, right? So first of all, predicting a bottom for the market is pretty hard to do. However, if an investor invested in those 10 previous bear markets, on the day the S&P 500 went down 20%, not only was that investment up on average 15%, but the probability of a positive result is 70%. So that's pretty substantial if you think about it. So the day the market goes down 20%, you invest in the S&P 500 or the stock market, you have a 15% return 70% of the time. Now, if that same investor extends their time horizon from 1 year to 3 years, not only does the return go to 32% on average, but their probability of a positive result goes above 90. So again, the key point is that the longer your time frame, the more successful, the probability of your success goes up pretty dramatically, and your magnitude of a positive outcome goes up as well. So pivoting to the bond market, you'll recognize this slide. Here we're looking at the Bloomberg US Aggregate Index as a proxy for the bond market. And like the key message of the stock, or being a stock market investor, the ability to maintain a long-term perspective is very important, because throughout the years, in this case going back to 1976, The intra-year low, represented by the red numbers, is always below where the gray bar, which represents the yearly return. But as Melissa Joy had mentioned before, the drawdown in the bond market has been not just dramatic on a magnitude. This index was down 13% at one point, but as you can see, having a negative return in the bond market is actually very, very rare. If we go back to 46 years, 42 of those are positive, or 91% of the time, this index is positive. So I think the point that we want to make here is that one, the likelihood of a negative outcome in the bond market is very rare, but also the year following that, those negative years, as unlikely as they are very, very strong. And also, as you can see on this slide, the average inter-year drawdown was 3%. So there's an old saying that a bad year in the bond market is like a bad day in the equity market. Now, that negative drawdown at as of June 30th was 13%. I don't know, and we're certainly not predicting that the bond market will end in positive territory, but we do believe that the worst is certainly behind us in terms of price returns in the bond market, which I think we'll be able to represent on the next slide. But again, the key takeaway of this slide, or the last slide, was that it's incredibly important to maintain that long-term perspective, whether it be the equity market, or in that case, the bond market. So let me finish by talking about why we think the worst performance of the bond market is behind us. And as Melissa Fradenburg talked about, inflation and rates have really been the driver of bond market performance this year. And we think that the worst of inflation is behind us. And we think the worst of rate moves are behind us for three specific reasons. One is economic growth, or lack thereof. Two is inflation, and three is rates and yields. So the chart on the far left here is expectations of economic growth or lack thereof. And I do want to be very specific or clear that we think that the US economy will continue to grow, but the rate of that growth is slowing down. So we think that history is a guide. Rates always follow that growth rate of the US economy. And as the growth rate decelerates, we're seeing yields fall accordingly. And as far as inflation, if we look at the chart in the middle there, and again, we're looking at expectations. Melissa had talked about some of the early indicators that lead us to believe that inflation has peaked. What we're looking at here is the market's 5-year expectation, as you can see, has dramatically rolled over, and yields, true to form, has followed that. The high of the 10-year treasury, the yield was just about 3.5%. The yield on the 10-year treasury today is just under 3%. And we think that is actually going to continue, which leads me to the third slide, which is historically rates and the yield on the 10-year treasury peak where the Fed funds rate will eventually be. And again, Melissa had talked about, where that may be, right around 3%. Well, again, the high point of the 10-year treasury at 3.5% has already taken place. That happened a few weeks ago in June at 3.5%. And again, we think that yields will continue to fall, not in a straight line, but as you can see, our expectation for the yield on the 10-year treasury is 2.85. And due to that inverse relationship, as yields have risen and prices have fallen, where yields fall, we believe that prices will increase. So therefore, over the next 12 months, we think that we'll see solid positive performance out of the bond market. So in summary, like I said, we've seen the high in yields at about 3.5%. Over the next 12 months, we see positive performance. And with that, I think that's a good point to hand it over to my colleague Hannah. And again, once again, thanks for having me on the call.
Thank you so much, Jay. I learned a lot through those slides. Next, we kind of wanted to talk about how all of these trends impact you as an investor and how you can make the most of them. So overall, this slide, it just kind of reminds us, as Jay said, if we maintain that long-term approach to investing, we really are rewarded when it comes to our average returns. So in this first chart on the left, each of these bars represents the percentage of time that the S&P's average returns were positive, going all the way back to 1950 for 5 different time horizons. So for this first bar on the left, we're looking at 3-month windows or quarter windows within the past 70 years. And just looking at those 3-month windows, the S&P had an average return that was positive 66% of the time. And as we move farther to the right on this chart, you can see that as our time horizon extends, the percentage of time that returns were positive for the S&P increases as well. So once we get all the way to this far right bar, which is a 15-year time period, we can see that the S&P's average return was positive 100% of the time. And similarly, the second chart shows a breakdown between stocks in green, bonds in blue, and then a 50-50 mix in gray. And we can see here this chart echoes the same sentiment. The longer the time horizon gets, our average returns stabilize. And we can really see that in all 3 of the categories. So we thought these were just a few good visual reminders on why it's so important to maintain that long-term mindset, especially in years where we see the type of market volatility that we've seen so far this year. So moving on to this next slide here, many investors, this year are finding themselves feeling just a little bit nervous about staying invested when we do see market dips like we've seen so far this year. And we totally understand that. I mean, it's very normal to have feelings of hesitancy and nervousness when it comes to seeing your portfolio drop. But sometimes in market periods like we're seeing right now, investors have the feeling that they might want to try to time the markets. And this chart on the right here shows how difficult it really can be to successfully time the market. Each of these blue dots show the best 20 days the market has seen over the past 20 years. And then the yellow dots show the 20 worst days. So timing the market successfully, a lot of people think it's just about getting it right once, but it's really about getting it right twice, because you have to guess on the right time to get out of the market, but then you're also guessing on the best time to get back in. So it's really not a particularly feasible strategy for most investors. And if we look at the table on the left, we can actually see how much it could cost us if we were to miss out on just a few of those best days. So if we were to stay invested throughout the entire 20-year time frame, our returns would average about 6.7%. But if we missed even just 10 of those best market days over that 20-year period, 10 days, our average return would drop to about 2.6%. And if we were to miss out on all 20 of the best days, our average return drops to 0. So it's just a nice reminder here on the importance of staying invested in times of market fluctuation, even when we don't feel good about it. Because the fact of the matter is no one knows exactly when these best and worst market days will occur. So really our best strategy is just to keep that long-term perspective. So this orange chart here, this is kind of a chaotic looking chart, and it shows quarterly returns going back all the way to 1982. And as you can see, there's not a ton of noticeable patterns. The chart's really all over the place. But if we bounce over to the next slide, we can see here over the same time period, if we were to have invested $10,000, how much it grows despite all of that short-term market volatility that we saw in the previous chart. So $10,000 invested over this 40-year period would have provided an investor with about $1 million in savings. So again, not to just keep driving it home here, but the long-term mindset is really where it's at, despite what we're hearing on a day-by-day basis or even a quarter-by-quarter basis in the news outlets and the media. So to take it to the next slide here, and to wrap up my section, oh, Melissa, can you pop over to the next slide? Oh, all right. So we just wanted to share this illustration, which demonstrates kind of, again, taking that long-term mindset, but taking it a few notches further. So both investors here, one's shown in orange and one's shown in blue, added $10,000 at the beginning of this time period, which was 1982. And the investor in blue added $2,000 to their investment portfolio each time the market dropped by more than 8% in a month. And the investor in orange did the exact opposite. So they took $2,000 out of their investment portfolio and essentially put it into cash or cash equivalents each time the market dropped by more than 8%. And the difference here is massive, as you can see. The fear-based investor in orange ended this 40-year period with a balance of about 600,000. And the more disciplined investor in blue ended that same period with an investment balance of about 1.5 million. So we know it's often easier said than done, but really the best thing we can be doing during a market drop is actually adding funds into our investment portfolios if our cash flow situation allows for it. So with that, I will go ahead and pass it over to Melissa Joy to wrap up.
Thank you, Hannah. Thanks, Jay, and thanks, Melissa. I really enjoyed the information that you shared, and I think that as we mentioned, we talked about the good, the bad, the ugly. We really tore things down and then built them back up. I feel much more optimistic about thinking about the future. But of course, we operate in a mode that acknowledges uncertainty and also knows the inherent challenges of predicting the future, especially in short-term time periods when it comes to the market. So I wanted to leave you with we're going to have a Q&A available. And if you look in your Zoom kind of operation settings, there's a Q&A section. So just click in there and type in your questions. Thank you for going ahead. We already have one question queued up, so that is great. But I want to leave you with some proactive thoughts for right now, as well as over time. And so we'll start with the best actions for right now. To begin, it is critical, and it has always been critical in times of uncertainty, and especially in times where there are negative returns in stocks or bonds, that you manage your emotions. And when you look at the visual on the right, the investor pendulum, you'll notice that there are shared and collective reactions to markets across groups of investors. And this is for personal investors, professional investors, I would say institutional investors. These are shared reactions. So when the market is down, when stocks are down, or your asset prices are down, several things are happening. Your mind is thinking, oh my gosh, I need safety. I need to hold on. You feel fearful. You feel despondent and depressed. There's moments of self-doubt. Have I made the right plan? These are shared universal reactions. And at the same time, just like Hannah pointed out, Warren Buffett's quote of be fearful when others are greedy and greedy when others are fearful, asset prices tend to be, with the benefit of hindsight, underpriced in an opportunity. And when the market is high or stocks or bonds are high, you feel euphoric, you feel smart, you have overconfidence. Perhaps you know are planning to spend that money that you know you're going to make from your next investment, and asset prices tend to be overpriced and less of a value or opportunity. Unfortunately, we can't pick highs and lows. They're very difficult to predict, even though with the benefit of a rear view mirror, everything seems to make sense. But I can think over the last 10, 12 years since the Great Recession of so many times where everybody thought things were going to fall apart, and it just wasn't the case. And the same goes when in moments of extreme declines where it's just felt like you should throw in the towel. So managing those emotions become critical. How can you do that? Well, breathe, think through things, have a thinking partner, perhaps your financial planner or investment professional, to talk through things, and remember that you have a plan. Some actionable ideas for right now: you can rebalance. We have been making adjustments within portfolios based on the market environment, a shift to value, a shift to shorter term bonds, a shift to other types of fixed income or alternatives to fixed income that we think might protect from rising interest rates. If you are an investor who has taxable investment accounts that you pay taxes as you go, we have been active in doing tax loss harvesting to build up, in the case, not to get out of the market, but just to pick up tax losses that can be used to offset gains. We know that last year it was very difficult to manage for taxes because the market was so high and everything had grown. And so you take advantage in times like this while staying invested. If you're someone who it makes sense based on your tax bracket, your preferences, and your financial plan to do Roth conversions, doing Roth conversions when asset prices are lower can stuff more money into those tax-free vehicles. So that's certainly something to consider. And with the rise in interest rates, we're having a couple things happening that we missed happening in the zero interest rate environment of the past, or recent zero interest rate environment. So we've written, our most popular blog ever written was about how should I invest in I bonds, and we'll make sure to, in our kind of summary, we'll include a link to that blog. But I bonds are based on the price of inflation, a government issued bond. You need to plan to own them for more than 12 to 15 months, but they have extremely high yields right now because part of their coupon is based on inflation. So yields north of 9% for bonds purchased right now. That rate changes, so no guarantees of 9% forever, but it's a very unique opportunity. Why haven't we invested all of our clients' assets in that 9% return? Well, you can only buy 10,000 at a time and you have to do it yourself. So, but we do have instructions if you're curious. But another thing that that is very much more recent is you're starting to see yield in places that it did not exist a little while ago. So for example, money market mutual funds or high yield investment accounts now have yields, perhaps they're rising, but north of 1.5% in some cases. That's quite attractive versus the pennies on the dollar that you receive in a traditional just, kind of deposit account. Little insider information, this is how banks and financial institutions make a lot of their money, is taking your 1.5% and not paying it out to you because you don't kind of shop around for where you park your cash. So we're having individual conversations with clients about how to kind of boost yield for cash in portfolios, but also that's something that you need to be thinking about for cash that you have in your emergency reserves or sitting outside because you just couldn't get paid for it and it wasn't worth the trouble, perhaps even a month or two ago, and that is starting to come back. So those are some opportunities for right now. But I would leave you with an enduring reminder that when markets rise or markets fall, your investment plan should be built so that it doesn't need to change. We have built an investment plan for you, if you're working with us, that is built for markets like this, even though we know that there is the possibility or perhaps inevitability in a certain percent of the time that the portfolio may be going down. It's when your goals change and your personal circumstances or life change and your financial plan changes that it's appropriate to make those changes to your plan. So what do we recommend that you do always? And we want to remind you in a time like now that you should consider doing. Well, first, use your financial plan if you have one, or get a financial plan if you don't have one, to stick with the game plan, and use the information from your financial plan to evaluate whether adjustments need to be made. They are built for both up and down markets. If you're someone who's pre-retiree and you are perhaps someone who's benefiting from a strong, very robust employment environment, boost your savings each year, and also make sure you're revisiting your financial planning. When you are an investor who pays taxes on the investments that you do, focus on tax-aware investing strategies. And when you're a retiree, focus on managing for taxes, but based on how you do your withdrawals. There are a lot of opportunities in there. And then also get the things off of your list that just need to get done. Whether if you haven't done estate planning, get it done. We're living in a pandemic and have been for a couple of years. These are important things. If you're underinsured or uninsured in certain areas of your life and you're able to be insured, review that. If you haven't started saving for the kids' college, but you have the opportunity to do so, let's get it started. So make sure that you're crossing the things off of your to-do list that really matter. As we are about to open things up to questions, I just want to thank people because, I think that the work of a financial planner is really most important in times like this. So we appreciate your trust and the opportunity to communicate with you and work with you and your families. And, we have a lot of gratitude for that opportunity to be a communicator and a collaborator with you for your financial needs. And here are some disclaimers that it is important that we include in the conversation. But with that, I know we already have a question that I'm going to be sharing with the team. And actually, I think some of Hannah's comments even address it because you must have had a crystal ball. So let me get to that question. And if anybody else has a question, please put it in there, or I would welcome you to follow up with a conversation with us about what you're wondering about one-on-one. But the question is, with bonds currently losing money and stocks as well, would you consider leaving a significant part of your retirement account in cash? So I think when we're thinking about what you should do with bonds, one of the most important questions is, where are you at in your life? So how are you using your investments? Are you an accumulator, or are you someone who's taking withdrawals? If you're an accumulator, then reviewing your, kind of overall investment pool. We've made some adjustments in our portfolios way prior to this rising rate environment based on the bond environment. So we've had an overweight stocks. Our old 60-40 portfolios are now 65-35, and we even have 65% stocks and 35% bonds. And we even have a little extra nudge so that we have a little bit more stocks in portfolios. But as Hannah mentioned, and Jay pointed out in his chart on bond declines and what happens next, when bonds tend to decline because of rising interest rates, that those numbers aren't kind of baked in forever. So the first question is, how are you going to be using that money in the short term? But typically in a declining bond market for one calendar year, the next year tends to be positive. And I would note most of those charts don't go back to the 1950s, which was the last low interest rate, rising interest rate environment. The 70s had a much higher interest rate, but that same was true in the 1950s, which I think is noteworthy. I think there's only one time period during that time that had 2 negative years in a row for bonds. So it really matters in terms of what your kind of perspective is, but we don't think that we're just on a race to, 10% yield when it comes to the Fed funds rate. It's just not built into the cards based on demographics, growth, et cetera. Anyone else have any comments on that question?
Yeah, Melissa, if you don't mind, I absolutely love that question, and I feel that, and I hear that question a lot. Is it's about cash, right? And in the short term, cash can feel safe, and on a relative basis, whether you're comparing it to equities or bonds, the downside that both of those have felt, you can feel good, right? But if we look at cash relative to both stocks and bonds over the last 12 months, again, we talked about consumer price index being up 9% over the last 12 months. Well, bonds have been down 10% and equities have been down 10% over the same 12-month period. So where cash may feel safe, unfortunately, it's actually gone down the same in terms of your purchasing power as bonds and stocks have. But unfortunately, when we look forward, cash actually is the only investment asset class that has a larger downside because of inflation than upside. So we talked a little bit about earnings and earnings expectation that should drive the equity or stock markets forward. And then also rates coming down, which should drive the price of bonds forward. So great question. It's one that's incredibly popular about cash, but we think that if investors have a longer term time frame, their money or investments are much better served in the bond market as well as the stock market. So hopefully that helps.
Yeah, and I would mention that we're actively looking for where the opportunities are in the bond market. I think this all relates back to one of the things I wanted to remind people about is that it's so easy to look in the rearview mirror during a difficult time or a great time and say either, we should have seen this coming or wasn't I smart because everything's great, right? And so this section of our conversation today is all about looking forward through the windshield. And so that you need the context of what's happened historically and what's happened recently. But you need to be thinking forward and proactive. And that, in that case, we want you to have adequate cash reserves. Cash is magic, regardless of whether it has a negative real return kind of forecast, but also we don't think that the purposes of long-term asset classes like stocks and bonds are gone. Another great question. Thanks, Jeremy, for asking. I inadvertently got my bond investments weighted toward inflation protected bonds a few years ago. Would have been awful in 2020 when we actually had deflation, but this is like a magic, serendipity for you this year. This has been great, but should I be balancing out to include more traditional bonds looking forward? Will their prices rise faster as inflation tames? And is there a good ratio between the two asset classes to maintain? Yes. So at least at a minimum, if you accidentally, but maybe on purpose, had more inflation protected bonds, this is a great reminder for rebalancing. So first rule of thumb, at least take it back percentage wise to where you, if intentional or if somewhat kind of preferring to wait toward inflation, take it back to where that original weighting was. But let's say that was just kind of an accident because there had been a little higher inflationary time and you looked on your list of choices and were like, that looks like a good idea because of past performance. Well, in some cases, a rule of thumb is 15 to 20% if you're someone who has a dedicated allocation to inflation protected securities. And if you're looking for areas to allocate to, I would tend to lean away from the longest term bonds, which have much more volatility, and toward intermediate term bonds, perhaps in higher quality corporate area or even short-term bonds as a way to kind of round things out if you're going to be making adjustments. Another area we didn't talk about, it was baked into what Melissa was talking about in terms of inflation, was just energy prices and gas prices. But just like Melissa was mentioning in her 7 kind of energy or inflation, kind of predictors, we've seen retail gas prices declining for 5 consecutive weeks. Who knows? Because I think there's still a lot of volatility coming, whether it comes to weather and what you need to cool your homes this summer, but also, there's a lot of concern about Ukraine, the Ukraine conflict and how Russia fits into the dynamics of supplying energy to Europe and the world. But that's worth noting too as an extra indicator for what the next numbers may be saying when it comes to inflation. Those along with that fertilizer are really baked in when you consider that most of our produce and food is shipped via trucking. So, the energy costs are vastly different from if we had, shipping via trains. and other, kind of modes of transportation. Anything else you're getting, Hannah, Melissa, or Jay, as kind of enduring questions of should I do this or should I do that?
Yeah, Melissa, if you don't mind, I'll jump in on that. It's the question of how much equity. When I talk to investors that they recognize that the market is down and they want to put money to work. The question is, where should I put this? Is it in US small cap? Is it US large cap? Is it international? Is it emerging markets? And the answer that I give is yes. We believe in diversification. We would never abandon, and Melissa, I think you'll agree, we would never abandon large cap or small cap or growth or value or international or emerging markets. What we think going forward is unlike the past, say 3 to 5 years, where it was the US versus everyone else, or it was growth versus value, and it was large cap versus small cap. We think that going forward, being more selective within each of those, the clear winners and losers will be within those categories. There'll be very clear winners in technology. There'll be very clear winners in growth or value. So the answer is yes. We think it's a good time to put money to work within the stock market, but the selectivity will be much more important than it has been over the last, say, 3 to 5 years. So hopefully that helps.
Well, and I guess I would mention along with that is a lot less questions about individual stocks, because there was a moment of, kind of the meme investors moment, or, digital currency and Bitcoin. Those questions have been less forthcoming, but another, kind of lesson that you don't have to get too cute. You don't need to go and, research to find the technology company that's going to, be the next Google in order to be a successful investor. In fact, the probability of success is much higher when you're able to use some disciplined, kind of broad market investing with those overlays of like looking for quality dividends or looking for parts of the market that may have additional value. So I don't see any more questions, but I just want to thank the team as well as the rest of the Pearl Planning team who's not on the call for all of the work that you do. And then additionally, thank, and we have one more question, but before that, thank the attendees of the call and listens to the replay. How do you currently feel about actively professionally managed portfolios versus buying index funds and holding them? Well, it depends on the person. So I think there are some people that could just buy and hold an index fund. You need to make sure that you're managing for times like this, where you don't kind of give up on your strategy. In our portfolios that we professionally manage, they are a combination of actively managed investments and indexes. And we think that there are some areas of markets that may be more appropriate to own indexes, and other areas where we would prefer to own active investments. Some of the areas that we like to own indexes are large company stocks, as well as getting exposure broadly to markets. It also can really reduce the cost of portfolios. And then some areas where we see opportunities could be an undervalued area, more difficult to invest in markets such as international small cap. Actually, bonds and fixed income are another area, but we're very much in the kind of sum of both when it comes to active and passive in the portfolios that we manage. And then it's just one by one whether you would be someone who would be a better fit to manage your own investments. There's a lot of complexity and nuance when it comes to how to access your capital and your money. And again, those investor emotions. So the answer, unfortunately, is it depends. When it comes to that, it's kind of a case by case. And with that, I think I would say thanks to everyone, but we would welcome follow-up conversations. Feel free to reach out to us. This is our phone numbers as well as our emails. And if you aren't receiving our newsletter, which has future events, please sign up at our website and feel free to call or reach out to us. Thank you so much.
Thank you, everyone.